Hey everybody, Economic Ninja here. I hope you are doing great. I want to talk about a really interesting story that I saw come up, and it is entitled, "The Fed May Need to Raise Rates to 6%, Monetary Economist Says." Now, the reason why I think this is very important is because the Federal Reserve has talked about they are going to get that Fed funds rate up to 5%. There's been talk between 4 and 5%, let's say, right? But there's an economist that comes out, a monetary economist, that is saying that that is not going to be enough. And we're going to go over that, but I want to highlight what this could impact, how it could impact the gold prices, right? Because as we see the Federal Reserve trying to get on top of inflation, the problem is they're going to collapse the economy, right? And we know at a certain point when certain metrics are met, like the housing market starts to crash, it's going to take down the stock market, things like that. As all of these things start to collapse, the Federal Reserve will need to eventually do something called pivoting. They're going to need to change their stance, which means they'll go from raising interest rates to drastically lowering them to try and spur the economy. It sounds crazy, but there just cannot be an even keel. And the reason why, it's because this money is literally made out of thin air. And it is, once inflation is let out of the bottle, like the genie out of the bottle, then you've got problems. And the inflation genie has left the building. As a matter of fact, the Fed doesn't even know how to catch this thing. They think they've got a handle on it, but they just don't. And so you know that it's going to drastically affect the price of gold, because eventually when they start to go in and have to print more money to help inflation, remember, like Nancy Pelosi just famously said,
"Oh, this money that we're printing is going to be great because we're going to be able to give it to you so you can deal with the higher prices."
You can't make this stuff up. I mean, not joking, all right? So I'm gonna dive into this, but before I do, I wanna talk about the sponsor of today's video, and I thank them so much, and that is Gold Mining Inc. The ticker is GLGD, and they are traded on the NYSE. I've talked about this company before. There's a lot of good points for it. I'm gonna go over that later, okay? But remember, I've been talking about gold mining stocks and precious metals mining stocks because as the price of gold goes up or down, the stocks are levered up and down, right? So there's a lot of volatility in the stocks. So there's ways to make money, and that's what I've been doing. But this is interesting. Here we go. It says the Fed's current target range for the overnight federal funds rate is 3.75% to 4%, right? Now there's been talks of 5, but this economist is saying it's going to probably have to go to 6, and here we go. It says the Federal Reserve needs to raise interest rates significantly higher to perhaps 6% to reduce inflation. Influential money economist John Taylor said on Friday. He told an economic conference in New York that rates are still quite low when measured in real inflation-adjusted terms, or when compared to monetary policy rules like the one he developed some 30 years ago and which bears his name. He says that's a concern. The Stanford University professor said via a telephone call, "You're not going to be able to get the inflation rate down unless you follow a policy which is similar to the policies of the past that are set out in monetary policy rules." Policymakers in September penciled in an eventual increase to 4.6% next year, though Chairman Jerome Powell suggested last week that rates might have to go higher than that. Remember, guys, Powell said there's about to be pain. There's going to be pain. So you have to get ready for it. And that pain he's talking about is massively higher borrowing costs, okay? Which is going to put a strain on the economy and force people to stop leveraging their money and stop speculating. And it is going to cause markets, both housing and stock markets, to crash, all right? Not only that, you have to worry about the ever so troubling bond market, because as rates go higher, why are people gonna wanna buy bonds at lower rates? So that's gonna drop the value of those bonds, okay? Now, Taylor highlighted the risk of a wage price spiral developing that fuels an inflation rate that is now running 3 times higher than the Fed's 2% target. Says here, one of the dangers going forward is that wages will increase and try to match the inflation rate more than they have already. He told the conference by the Shadow Open Market Committee, a group of academics and former policymakers that monitor the Fed. And the reason why that's dangerous is because companies simply cannot keep up with giving people more money per hour to work just so that they can afford the common basic everyday necessities, because they are faced at the same time with smaller and smaller sales amounts, smaller growth, things like that. They're not growing like they used to because people aren't spending as much money on their goods and services because of inflation. You see where this is a two-edged sword and can really come back to bite these companies, which will eventually lead to their demise. all right? When your employees are your most expensive expenditures, right? And that's usually low-hanging fruit when a company is reorganizing or needing to cut back. They lay off a certain amount of their employees because they can save a lot of money, all right? So people need to realize that. It's very important. Now, so how does this play into gold? And I think this is very important. Gold actually does very well during a Fed tightening times as interest rates are going up. Investors get more and more fearful that as rates go up, the market's going to collapse. So when the Fed starts raising rates little by little in the beginning, it doesn't really have an effect on gold. But as it starts going up higher and higher and that squeeze is put on the consumer, very savvy investors know, you know what, it's time to go to gold because we know that there's going to be a crash. We saw this during the 2015 tightening cycle, and we are starting to see it now. There are a lot of trends that were spotted when gold was in its 2019 price and as to where it is now. And so I want to talk about that. So without further ado, I'm going to need some notes. So do you have some notes for me? Sweet. All right, here we go. All right, let's talk about first the Gold Mining Inc. Corporation, right? The reason why Amir Anani started this company, large company, again, traded on the NYSE, which is really neat because any investor has exposure to this, no matter what third-party application they have that buys and sells stocks or a brokerage account. I really like that. That's really neat. To give you an idea of the leverage of these gold stocks, we're going to use this as an example. In 2020, the price of this stock was 90 cents a share, right? And that was right there. It was like December of 2019. In the last 6 months, if you notice, the stock's price is at the exact same price it was back in the end of 2019, early 2020, right? Before gold started to take off. In the last 6 months, the gold price is down 3.79%. So if you look at it as compared to other investments, gold has really, really held its value as things start to go up, right? Where you go, well, wait a minute, Ninja, wouldn't you want it to go up? Well, it seems like everything's going down, right? Stock market's having problems, bond market's having problems, crypto's having problems, right? Gold in the last 6 months is down just a mere 3.79%. So it hasn't moved. Now, GLGD, the stock price, for the last 6 months, pretty much for the last, 5 months, you've seen that price stay steady at 90 cents, right? So it's waiting to see what gold does. Gold's been pretty darn steady, and so has this stock price, okay? And that's why I'm getting into some of these stocks because of the leverage amount. In December 2019, GLGD was 90 cents, like I said, and then it started to take off. And it ended up topping out right around $2.50 later that year, August of 2020. All right, so what is it, mere 9 months later, you saw it go from 90 cents to $2.50. On a percentage basis, that's huge, but this is why. Because in 2019, gold was sitting at $1,500 an ounce, right, in 2020. Then all of a sudden, December 2019, then all of a sudden, everything went to chaos because the world shut down, right? And the gold price went from $1,500 up to a little over $2,000 an ounce. It was actually $2,032 an ounce. All right. When that happened, gold went from 15 to 2,000, went up $500, a little over $500. You literally saw, as an example, GLGD go up from 90 cents to $2.50. Way higher on a percentage basis. So to give you an idea of what happens with these stocks when the gold price starts to move, right? And gold price starts to move because of uncertainty, right? We even saw a time in 2020 as the stock markets were crashing, everything was closing down, we saw gold come down very sharply, the paper price of gold. But what happened was investors dove into the physical market, they bought up all the gold, and then it was hitting the news wires, and all of a sudden you saw the paper price rebound. So even with that flash crash, essentially, gold did very well on a percentage basis over that 9 months. All right, so that's what you're looking for in the next cycle. When is gold gonna make its move? All right, so here we go. I got lots of notes here. I've talked to you about this company before, and I'm gonna go over a couple points, but analysts have one analyst in particular, H.C. Wainwright and Company, has a buy rating at $6.25. It's a buy rating with a price target of $6.25. That's really impressive because they know where this market can go. Now, on top of that, this is a multi-million ounce equivalent resource with 16.2 million of M&I resource and 16.2 inferred resources. U.S. Gold Mining is a wholly owned subsidiary of Gold Mining Inc., and it's focused on advancing a specific property called the Whistler property, and that's a gold and copper project, right? Well, what's really interesting is that this is a spin-off company. It's wholly owned by Gold Mining Inc., but now the company has the ability to build that into a larger company and look to either sell it or do something different with that down the road. So that would bring more value to shareholders of GLDG, okay? The company has $82 million in cash and equity holdings. It means right now they have 20 million in US BMO facility, a US dollar denominated BMO facility, which is enough funds to maintain and advance their portfolio. So that is something that's very important as well. Does the company not only have good assets, but do they have a credit line or the ability to, they have cash on hand that they can use to keep advancing these projects and bringing them to either full-blown production or selling them to a company that is already in production and wants to acquire that asset to give their company more value, okay? So Admir Nani knows that. And it even states that they're always continually evaluating spin-out opportunities, including REA uranium project. So again, they're constantly looking at the properties they have under management, their exploration sites. What sites can we turn into companies and spin out where we own the paper, we own that company, and then we can eventually look to sell that company, market it, and sell it to another large major mining company. So that is really important, okay? Shareholders include, and this is important, right? You wanna know who is invested in this company. Large companies like BlackRock, Sprott Global, the KCR Fund, which was made by Katusa, Doug Casey, and Rick Rule. Three major players in the metals and mining industry, all right? That is what I'm always looking for. Companies that have big institutional investors, well-known investors in the space. And to me, I look at their past abilities and experiences to help me. They do their own due diligence. They put their skin in the game, their money on the line. So I have more confidence putting my own. Guys, this isn't financial advice. I'm not a financial professional, but I'm investing in this sector because I want the leverage to the gold price. Now, can gold go down? Yes, it can. All kinds of different ways. But what's really interesting, even though gold is off of its all-time highs by not much, from what, a little over $2,000, we're sitting at about $1,750 an ounce as of the recording of this video. Think about this. To go and buy physical right now, it's all over the news that the premiums have exploded higher and the delays of getting that physical in your hand are taking longer because literally mints around the world physically cannot keep up with the physical demand for physical gold. So what happens next? People and companies and countries that see this are looking to buy gold in the ground, so they're buying shares. I have a personal story from a CEO buddy of mine that called me as CEO of a producing gold company. And he said a fund out of Turkey contacted him and wanted to take a 51% position, which he said, no, if we're good, we don't need that. We're fully funded, we're doing great. But they want ownership of this gold mine. He said, why? And it really came down to is we need to buy gold in the ground right now, and we're trying to get leverage to it. And the reason why is because we know where the gold price is going and our currency is failing. Think about that. That is happening all around the world. People are looking right now, funds, large hedge funds, mutual funds, they're looking for gold in the ground. Why? Because the currency is failing, and that is very important to understand. All right, guys, that being said, I thank you so much for watching The Economic Ninja. I promise I will pick that up. Is out.